So good morning everyone. Thank you to UNU-WIDER for the invitation and the wonderful conference. I'm Roxanne, I'm a postdoc at the ZEW and I want to present this paper on corporate taxes and export competition with Tobias, Antonia and Nadine, who is chairing the session. So let me dig in right away. What we've seen over years and decades around the globe basically is that corporate income tax rates have decreased quite drastically. And the standard explanation usually provided for this in the literature is that over the same time period, both profits and investments have become more mobile. So in order to attract them and keep them in their jurisdictions, national governments have been incentivized to slash their tax rates. We think that there is an alternative or additional explanation for this decline in tax rates we have seen, which is that of trade liberalization. Because over the same time period, firms from different countries have started competing with one another in global markets. And tax cuts in one jurisdiction could then boost the competitiveness of domestic firms from that country vis-à-vis their international competitors. And indeed, we see this being used as a common justification in policy processes, for example, in the United States a couple of years ago. This figure basically just illustrates what I've already said. So we see here the average corporate income tax rate globally declining over the last decades and over the same time export and trade volume increasing steadily. Empirical evidence on this is largely missing, however, and this is where we want to come in. So we look at the impact on traded quantities, and the specific research question that we ask is whether corporate tax cuts have an effect on the competitiveness of firms. We test this using data from South Africa, where the Revenue Service has provided us with rather detailed administrative and customs data, and indeed we find a significant effect of the corporate tax rates of international competitors on the exporting performance of South African firms. I will talk about who these competitors are in just a second. For the sake of time, I'll skip most of this. Importantly, in South Africa, the corporate income tax rate throughout our sample frame has been at 28%, which is rather high for a non-developed country. And if we look at the rest of the world and the rest of the African continent, we see that the average tax rates have been declining over the same sample period, and that somewhere here is the South African tax rate. And we ask whether this differential development impacted South African exporters. So we use this data from SARS that is on a transactional level, so it's very, very detailed, and for example holds information on the value and volume of the transaction, the country the export is sent to, and a product category which is rather fine on the 6-digit level. We're later on able to link this to exporting firms. We look at the years 2012 to 2019, and we aggregate this on the firm, product, destination country, and year level. And then what we do is we combine this with some bilateral trade data worldwide from the UN Comtrade database for our base year to identify the competitors I've just talked about. This is a very stylized example just to get all of us on the same page. So imagine there's a firm in South Africa that exports a product, let's say diamonds, to a certain destination market, let's say China. One way to think about international competitors would be to think about firms in China that also deal in diamonds. However, research has shown that exporters from one country and domestic firms from another are different on a variety of dimensions. So what we think is more suitable is to look at other countries that also export diamonds to China in our example. So let's say the only other countries that do that are Belgium and the United States. This also has the advantage that we can basically control for any confounding shocks at the destination market level. So now we look at the trade volumes of these two countries, of our competitors, and their tax rate. So on our base here, let's say for all the non-South African trade of diamonds to China, Belgium is responsible for 30%, the United States is responsible for 70%, so we would weigh the Belgian tax rate by 0.3 each year and the US one by 0.7. So here we get to an average tax burden of international competitors. And the notion now is, if one of these competitors slashes their tax rates, for example, the United States, this would boost exports of diamonds to China from the US, and in a second order effect, decrease the exports from the South African firms. I will just briefly, this is the estimation regression that we run. This is the average tax burden I've talked about, and we're interested in this beta here, and we expect this to be positive, which is indeed what we find. So the notion here is that if the corporate tax rate of competitors decreases, traded quantity or exports from South African firms decreases as well. And we find that across a variety of specifications. This is a difference in difference model, so we go through some identifying assumptions. Let me show you the event study graph, so basically the effect per year, and we see here very flat pre-trends, meaning that treated and control groups emerged in parallel in their export quantities prior to treatment, and we can also see that this effect seems to be dynamic in time, evolving over a couple of years after actual treatment took place. Another concern one might have is that if one of the product routes of the South African firm is affected, it will simply refocus its effort onto a different product or a different trade route, which would bias our results. There is some evidence that this hardly happens in less developed countries, but we still try to address this in our regression equation. So what we do is we include the average tax rate of a firm that is faced by all its other products. So if we go back to our stylized examples, all the products that are not diamonds. And in order to do so, then we can basically exclude this effect from this beta here. And we find that our beta is still significantly positive. So this concern I've raised does not seem to be very strong in our case. One thing I want to do, thank you, is zoom in on the Tax Cuts and Jobs Act, which I've already briefly mentioned. So this was the tax reform in the United States a couple of years ago. And it was a massive, massive tax cut from 35 to 21% on corporate income. And we ask how this one specific reform affected South African exports. This is now a basic difference or a classic difference in difference designs. So we expect negative effects, which we do find. So basically treated firms, which are the ones that are exposed to US competition, they see their exports decline post-reform vis-a-vis control units. This is what this coefficient tells us. Again, the dynamic graph shows that this effect evolves over time and that the pre-trends are rather stable. The last couple of minutes I would like to use to talk about repercussions on the actual firms. Because if these firms are subject to these shocks from abroad, then this might actually negatively affect their real activity in South Africa. For example, the income earned by shareholders or workers. In order to identify this, we take our competitor average tax rate to the firm level. So aggregating over all the products and routes that this firm is active in. And then have this new beta coefficient here. And again, we expect this to be positive. Again, meaning that if the firm-specific competitor tax rate goes down, the outcomes we're looking at, specifically labor cost, profits, and employment of the same firm also decrease. And indeed, that is what we find. So we find strong and significant effects for both profit and labor cost, only weakly significant for employment, but all of them seem to decrease somewhat. This holds for different specification designs, and also if we repeat this exercise with the Tax Cuts and Jobs Act. So if I only use the Tax Cuts and Jobs Act again, these coefficients are rather similar, and the employment coefficient increases in its significance. So let me very briefly conclude about what we've seen here. what we find is that taxes of international competitors indeed impacts the export competitiveness of firms in South Africa, because when these competitors from abroad are subject to tax cuts, they seem to be subject to a boost, and basically as a second order effect, the export sales of the South African firms in the world market then decrease in respect to that. This, in our opinion, provides an alternative rationale for the race to bottom that we have seen in these corporate income tax rates worldwide over many years. And key takeaway for me personally is that we show that these corporate tax cuts actually exert a negative externality that spills over to other countries, which might be particularly severe if these other countries are still developing nations. Thank you very much.